I'm calling for gold to 20,000 in the early 2030s. So by 2030 or 31, I think you could see gold at 20,000. So if you get down to say 2,100, you're talking almost a tenfold move. Silver, I think, can get to 500. So if you're down at 25 and you go to 500, obviously it's a 20-fold move. So I think gold and silver are going to be the leaders of the next cycle.
Following the Federal Reserve's interest rate decision, significant profit-taking is expected in the precious metals market, particularly for gold and silver. Although the Fed's anticipated interest rate cut initially triggered a rebound in gold prices from a recent low, the hawkish tone regarding future rate cuts tempered investor sentiment. The Fed's indication of a more restrictive monetary policy path in 2025, driven by ongoing inflationary pressures, put downward pressure on gold prices. DavidHunter forecasts that a global bust will accompany an 80% bear market across most assets. He anticipates gold will rise to $3,400 before the bust occurs, and even if it experiences a 40 to 50% decline, he believes it could find support around $2,100, roughly a third of its increase. His pre-bust target for silver is $75, but in the event of a sharp correction, he expects silver to fall to the mid-20s, representing a substantial drop from its peak. In 2024, gold saw a year-to-date increase of 19.57%, and silver reached a 12-year high, with both metals outperforming significant indices. Geopolitical tensions, U.S. monetary easing, and growing demand for renewable energy drove this performance. Looking ahead, gold is expected to remain elevated relative to historical averages. At the same time, silver will likely experience modest gains as supply may struggle to keep up with the increasing global demand for the metal. David is confident that gold and silver will lead in the next economic cycle, emerging as crucial assets in the recovery following the bust. He further asserts that manufacturing is unquestionably in a recession and believes that at least half of the population perceives themselves as in a recession. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update.
For sure, manufacturing is in recession. For sure, half the population feels like they're in recession. But whether technically we'll go back and date it and find we were or not, maybe a moot point. I'm not sure. Like I said, I think we're going to probably see a more of the same, what we've seen this fourth quarter in the first quarter, but with slowing. So, GDP may not get into negative territory in the first quarter, but it certainly will slow, in my opinion.
What happens to the price of gold in a global bust?
I think a global bust, I'm calling for a 80% bear market to accompany the bust. Wow. So the bust refers to the financial system and the economy. So there's going to be a big bear market. In a global bust, most assets get hit hard. I think it's going to be a deflationary bust. So, assets will be deflating, but so will basically price levels in the economy. So I think gold probably gets hit along with most assets. Won't be like, the stock market. If the stock market peak to trough goes down 80%, gold might go down 40 or 50%. Silver, on the other hand, is much more of a cyclical metal and much more volatile. So I wouldn't be surprised if silver, dropped closer to what the equity market's doing. And my numbers on the metals, I have gold going to 3,400 now before the bust. So if you drop, and probably won't even be 40 or 50%, you could drop back, say, to 2,100, which would be basically a 30, a 1/3 retracement, at 2,100 being where we broke out. So I think that's probably what you're looking at in gold. Silver, on the other hand, I have a target of 75 pre-bust. And if it, gets hit hard, you could see it back to, the mid-20s again. So, basically that'd be 2/3, hit.
And then post-bust, do you presume that these metals begin to continue their rise up?
Yeah, for sure. I think if you get that opportunity in a bust where they do drop like that, it is a buy of the decade for sure. I'm calling for gold to 20,000 in the early 2030s. So by 2030 or 31, I think you could see gold at 20,000. Silver, I think can get to 500. So if you're down at 25 and you go to 500, obviously it's a 20-fold move. So I think gold and silver are going to be the leaders of the next cycle. The next cycle's, and I'll explain why in a minute, but the next cycle is going to be an inflation cycle. I think ultimately a hyperinflation cycle, meaning we could see inflation go from deflation in 2025, early 26, to as high as 25% by early next decade. And so I think the precious metals will do very well in that environment, as will a lot of commodities. I'm predicting oil might get down to 30 in the bust, and I'm predicting it'll get up to 500 early next decade. So, you've got commodities, I think, are going to be the story of the next cycle. Tech, there'll be obviously places where tech plays, et cetera. But if we get that kind of inflation, you're going to have a bond market selling off big, and you're going to have interest rates going, tracking inflation. And that's not good news for the general stock market.
Americans are running out of money. That's the stark reality. The savings accumulated during the pandemic? Gone. Those stimulus checks that once fueled spending like there was no tomorrow? Spent. Now, consumer spending, the backbone of the U.S. economy, is beginning to falter under the strain of depleted wallets. And as for inflation, it's still a concern. While it's better than the 9.1% peak in June 2022, October's 2.6% rate shows we're far from being in the clear. Hunter stresses that the economy is overloaded with excesses, making it impossible to avoid a downturn. He cautions that the Federal Reserve's delayed reaction to these imbalances could turn what might seem like a typical recession into something far more severe. Additionally, Hunter forecasts that the response to this bust will include massive fiscal and monetary stimulus, potentially reaching $20 trillion, significantly surpassing the $5 trillion injected during the 2020 crisis. Now, let's redirect our attention to a video.
The most likely of the other scenarios would be a recession. So it's very possible that, I'm making the bet that with such massive leverage, even though a lot of that leverage is sovereign debt, that with that kind of leverage on the system, you're going to get an outsized correction in the economy, an outsized correction in the financial system. It's possible we get through this without a bust, and it's just, I won't say middle of the road recession, but it won't be a bust. And it's possible we get that where, the equity market doesn't go down 80%, it goes down 50%, or 45%, something like that. And the bond market doesn't have that kind of a run in it. Rates will come down as the Fed eases, as the Fed reacts to the recession, but you won't see new lows on rates. So it'd be all in the same direction, just not nearly as dramatic. But I think either way, we have too many excesses in this system for us to have a no landing. I mean, I know that's out there, that people think we kind of skated through this and, you're not going to have a recession. There's an awful lot of excess in the system that has to be shaken out. And frankly, because of the pandemic partially, and because of a lot of other things, central banks around the world, particularly the Fed, I think are fighting a war. They're fighting the last war, which is inflation. And in so doing, are going to be slow to respond to what is going to be a much slower, an economy that's going into recession. And that's another reason why it can get out of hand, is if they react slowly, you can go from looking like a normal recession to something much worse in a hurry. As I say, the seeds have been sown for the bust, in my opinion. I'd be very bullish, because I think you are ushering in a new era of pro-capitalism. Nobody would have believed prior to this. I think it was, anytime it was talked about, it was kind of laughed off as, they say that every election or whatever. I think this time around, people realize that things have changed. And so I'd be, without worrying about what's come before Trump, I'd be pretty bullish. But because of the seeds being sown, I think, first of all, I don't think his policies will happen fast enough to head off a bust next year. And then secondly, he's going to have to abandon some of that or softens, cut back on some of what he plans to do while we're fighting the bust. And thirdly, the macro really overwhelms everything, because if you get a bust, the other part of my bust scenario is that the reaction to the bust will be massive money and massive spending. I mean, you'll see fiscal and monetary stimulus like we haven't seen even 2020, which was 5 trillion basically. I think you could see 20 trillion if I'm right about the banking crisis and the bust. I think it might be something on the order of 20 trillion coming out of the Fed, proportionally similar around the world, every central bank. And again, we tend to focus on the US, I certainly do, but look at what's going on in China. I mean, they are deflating and they are finding it very hard. It's not business as usual over there where they're just going to, blow it back up again. I think they're really having a hard time because of all the cross currents over there.
Geopolitical tensions and escalating government debt are expected to push gold prices above $3,000 per ounce for the first time in 2025, building on the record highs seen this year. Silver prices, which reached their highest levels since 2012, have been driven by a persistent supply deficit and growing investor interest as geopolitical uncertainties fueled safe haven demand. What will 2025 hold for gold and silver? As the new year approaches, investors are closely watching how Trump's policies and actions could impact the precious metal and supply and demand trends in the space. We welcome your insights in the comments section below. If you found this content valuable, don't hesitate to give it a thumbs up, and don't forget to subscribe to stay informed. Thank you for joining us on this journey.